All right. Good morning, everyone. It is 7:55 in the morning of June 14th, 2022, and this is my pre-market strategy session. So, the title to today's video is Hot PPI equals down day, cool PPI equals relief rally. And so, what that means essentially is that there is a producer's price index expectation today of, I think it's like zero point 0.8. And so if the PPI comes in today greater than zero point 0.8, then that will be hotter than market expectations, which means the market will expect the Fed to be even more hawkish on rate increases this year. In fact, there's a rate increase announcement coming out on Wednesday, I believe it is. Today, the Fed meets. There's some kind of I think it's the Federal Open Market Meeting Committee, FOMC, whatever that stands for, Federal Open Market Committee. Yeah, and so they're going to announce on Wednesday what their intention is for raising rates. And I imagine that it's going to be, a 0.5% or 50 basis points increase, even if PPI comes in hotter than expected. Essentially, what I imagine is going to happen is that as the Fed raises rates, eventually CPI or inflation will come down to meet the Fed. The sort of muting or the, what I want to call it, the stifling of GDP, according to the Fed tightening, will be enough to bring inflation down. So the Fed won't have to go to, really, technically speaking, the Fed ought to go to, at least or above the current inflation rate, which is really high. The last reading was 8.6% year over year. And so the Fed ought to be putting their short-term rates right on up there with 8.6%. But that would really cause a lot of turmoil. And believe what the Fed is attempting to do is to raise rates and then watch inflation come down to meet the rate that the Fed is putting in place. So if the Fed raises to, let's say, 4%, the expectation is that sort of stifling of GDP and of money movement and so forth will cause inflation to come down to 4%, and there will be a meeting in the middle instead of the Fed having to just jack it up, and jack up the short-term rates to be able to stifle the inflation. I imagine if that doesn't work, I imagine that the Fed will jack rates up to as high as they need to go in order to put inflation in its place. So, okay, the first chart that I have up right here, this is the 10-year minus the 2-year. So the 10-year rate, I've forgotten what it is right now. Let's go take a look at it real quick. Let's see, risk range. So the 10-year right now is at 3.36. Wow, look at that. That's really taken off. People are ditching bonds big time. And so, whatever the 2-year is I don't have the 2-year up. I'll just pull it up. I ought to have it up anyway. Let's say, let's go to, I think it's a note. I don't think it's a bond. It might be under bonds, but let me just go here. 2-year note. Two-year, 10-year, US 2-year. I think let's go current month. I think. Why aren't you working? 2-year. Here we go. Where I swear sometimes trading view is such a pain in the ass. 2-year government bonds. Why aren't you showing up? I'm hitting add. Do I already have it up? No, I don't see. Where's. Got a trading view. Come on. Jeez, that was a lot harder than it needed to be. Okay, so let me move this up. So there's the 10-year. So here's the 10-year at 3.36, and here's the 2-year at 3.32. And let me go to my indicators. And so the 10-year minus the 2-year has a 0.0, has a 4-point spread. And yesterday it dipped down below 0, and then it opened below 0, so it inverted and has climbed its way out of inversion today. You can see back here on the 1st of April, it closed inverted and opened inverted again, and then took off to the upside. So this time, I imagine what's going to happen is that it's going to. There's been a little kind of saving grace right here. But it's the inversion. It's headed for inversion. Usually, the second time it might do this a third time. Maybe might do a third pop, but it's headed down at this point. So, yeah, recession is pretty much guaranteed at this point. No big deal. I mean, recessions are necessary. You know, it's they suck, but. You know, it sucks to go through, and stocks don't perform well during recessions, but, you know, that's the way it goes. So today at 8:30 in the morning, PPI is going to get released. And PPI is upstream, essentially, of CPI. So if PPI comes in hotter than expected, that means CPI is probably still going to come in hotter than expected, which means the Fed is going to be that much more hawkish. And with the Fed being hawkish, it's essentially drying up liquidity, and there's nothing that the stock market loves more than liquidity. You know, easy money policy, risk on. You know, so the more hawkish the Fed gets, the more liquidity is bound to dry up, and the more liquidity will come out of the stock market. It's about time. I mean, we're overdue for a major correction in the valuation of stocks, because there's just been so much easy money policy and stimulus pumped into the market from essentially 2001 forward. Essentially, there's been quantitative easing. And I don't even know how many trillions of dollars. I've lost track how much quantitative easing there's been. How much government stimulus there's been between COVID and whatever other kind of housing crisis that we went through in 2008. There's just been a boatload of cash pumped into the market. Really, the market is a derivative of the debt market. Really, the stock market is a derivative of the debt market. I mean, really. And so the amount of liquidity coming out of the bond market with quantitative easing coming soon is going to be a derivative effect on the stock market. So, today, from what I can tell, if PPI comes in cooler than expected, then there will be a notion that inflation is starting to ease. and that will give us a little bit of a relief rally, at least for a couple of days, 1 or 2 days. If it comes in hotter than expected, though, that means inflation is going to be that much more. There's going to be that much more pressure on the Fed to raise rates to stifle inflation, and so that'll be a down day. So at 8:30 in the morning, here in about 24 more minutes, we'll get the PPI reading, and we'll get sort of an idea of what the day is going to be like. I imagine if PPI comes in hotter, there'll be another gap down. And actually, look at that volume too. Let me see. So that volume is really increasing here as things go down. So in order to keep kind of things sort of orderly, so there won't be like this. If the market needs to go down further, this is sort of backwards. I imagine that there will be a bit of capitulation, so that at least the downward move is, instead of seeming panicky, this is creating panic right now. And so instead of seeming panicky, it could be orderly, right? An orderly downward move instead of a panicky downward move. But there's definitely some panic happening right here. And if PPI comes in hotter than expected, I expect to see another gap down on the day, and it'll be a big down day. If it comes in as expected or cooler, then we ought to see at least some consolidation or a little bit of a rise back up. A relief rally. All right, everybody, good luck out there. Keep your risk tight. Click like, share, subscribe, leave a comment, tap the bell, and I will see you at tomorrow morning's strategy session. I am out.